The broadcast is now starting. All attendees are in listen-only mode.
Okay. Hello everyone. Welcome to our Bursa Malaysia webinar. So our topic for today will be Chart Pattern Masterclass with our speaker Pauline Yong, and I'm Smita, who will be your moderator for today. So before we begin, can you please click raise the hand button if you can hear me clearly and if you can see the screen? Again, can you please click raise the hand button if you can hear me and if you can see the screen clearly? Okay. So I see a lot of you raising your hands, so I believe that you can see my screen and you can hear me clearly. So, as usual, before we begin, I'll just go through the disclaimer with you. Anything you hear today is purely for educational purposes only. So in no way the speaker of Bursa Malaysia is responsible for any of the buy or sell calls that you make to your stocks. Again, this webinar is purely for educational purposes only. And let me go through the webinar series that we have planned for the whole year. So every first Tuesdays of the month will be our Bursa Beginner Webinar series. And on the second Tuesdays of the month is our Chinese webinar series. So if you're interested to learn in Chinese, you can always join our Chinese webinar series as well. And as for our intermediate and advanced webinar series, it will be on the third Tuesdays of the month, and it's designed for retail investors. So for our speaker today, we're going to have Pauline, and Pauline is the Managing Director of Sigma Wealth Sdn Bhd. She is a certified financial, sorry, 1 minute. Okay, so she is a certified financial planner and a licensed financial planner with Security Commission license CMSLR and a licensed financial advisor representative. Pauline has been in the training industry for more than 20 years. She was an economics lecturer for 16 years, and now she is the course facilitator for the Financial Planning Association's Malaysia, FPAM, CPE courses. By far, she has published 5 investment and financial planning books and currently a regular writer for various magazines and newspapers. Currently, she is a regular commentator for City Plus FM radio station every Wednesday morning for Stock Market Outlook. She received her MBA in Finance from the University of Leicester, UK, and her BBA Honours in Finance from York University, Canada. In addition, she is also a certified chartist in Malaysia and a member of the Society of Technical Analysis, UK. So, Pauline, I will pass over the screen to you right now.
Okay. Hi, good evening, everyone. Thanks to be here. Can you see my screen?
Yeah, Pauline. Okay.
Okay. Hi. So good evening, everyone. So my name is Pauline Yong. So today I will talk about chart pattern. And can you see my screen now?
Yes, we can see.
Okay, let's see. Yeah. So today's agenda, we will go through the basics of technical analysis and then the trend lines, support and resistance. Because for technical analysis, when today's lesson, we'll talk about chart patterns. However, for chart pattern, it is very important that we need to apply together with the trend lines and the support and resistance. So today, I hope by the time when you go, when you finish this webinar, you always remember this. Chart pattern always come together with the trend line and the support and resistance. So these three things has to be together. So today, I hope I can show you how to read the chart together with the trend line support and resistance so that you can apply this confidently in your trading. And I also go through the chart patterns recognition, the application of chart patterns, and then followed by the Q&A. So let me show you this chart. So my objective for today is that by the end of the day, you will be able to, number one, look at this chart and then be able to tell me what is this chart pattern. Okay. Number two, be able to tell me the support and resistance. Okay. And number three, be able to draw trend line. Okay. Draw trend line like this. Okay. Trend line like this confidently. Okay. So let's go through. Yeah. Yes, Sumita, do you have anything? Okay, sure. All right. So what is technical analysis? There are two schools of thought. You have the fundamental analysis and then you have the technical analysis. So for the fundamental analysis, you look at the financial ratios, the P&L, the profit, and the fundamentals of the company. Whereas for the technical analysis, you will just focus on the charts only. The charts will tell you the price action. Okay, so that means you make your decision based on reading the charts only. So can these two be combined together? Yes. So for me, I usually combine these two together. So it depends on whether you are going for a short-term trading or a long-term investment. So usually for me, if I were to go for a long-term investment, I will use about 80% fundamental analysis, and then about 20-30% of technical analysis for long-term investment. I would tend to look at the charts less often if you are going for long-term. However, if you are looking for short-term trading, I would say about 80-90% is purely on charts, technical analysis. So today we will look at I will use a simplified way to explain to you what are the chart patterns and how to utilize them effectively and efficiently. Okay, so first, you must have the assumption, because when we look at this technical analysis, they must be based on certain assumption in order for this analysis to be able to apply. So number one is that the history will repeat itself, and then past trends will predict the future ones. So that is why when you look at the chart, sometimes you look into the past 20 years of data. So you have to look at the certain patterns. So the technical analysis will based on the fact that the history will repeat itself, and then the past trends will predict the future ones. So that's why we need to study the technical analysis so that we can predict into the future. Then the price pattern is the sum of all the behaviors of the market crowd. Therefore, it is tracking the psychology of the market. Later, when I go through the basic of this chart pattern, and I'll go into more detail about the theory part, and then you will understand the psychology behind it. So, and then we must also know that there are different time frames. For trading or investing, either you are trading or investing, it is always good that you have to establish in the beginning what is the time frame of whether you are holding the stock for a short-term basis or for a long-term. The time frame has to be established. So short-term trend refers to a period that is lasts from days to weeks, probably 2 to 6 weeks. An intermediate trend will be referring to last from weeks to months, and then long-term will be months to years. Okay, so first, the trend lines. So before we go into the chart pattern, let's take a look at the trend lines, because it is important. And I'm sure the very first lesson that you go to any of the technical analysis classes, they will tell you the trend lines. And the trend will be either you have an uptrend or downtrend or horizontal trend. So for a downtrend, what you are looking at is actually looking at this high point and then high point. So you are getting to see lower high. Okay, you have lower high and lower low. Okay, let me do the pinpoint here. Okay, you see this high? Then over here you have a lower high, and then the bottom here you have a bottom here, and then over here as the price goes, you have a lower bottom. So you have a lower high and a lower low. So this is by definition the downtrend. Okay, definition of a downtrend, which means it's a lower high and lower low. Then the uptrend will be, definitions of the uptrend will be higher high and higher low. You see the high is getting higher from this point to this point. And then for the bottom here, you see the bottom is moving from one place to a higher bottom and then higher bottom. So that means this trend is moving up. Okay, then you can connect this line. And then horizontal will be horizontal trend. Okay, so this part you have to be sure in the, you have to establish, okay, for technical analysis.
Okay.
Then, so this is what I said just now. And trend line can be used as a support or resistance. So if trend line is steep, it may not be sustainable. And the longer the trend line, the more significant it is. So let's see. So it says that when you are moving down, for example, from this to here. So the first downtrend, the first crash, okay, the first crash is very steep. Okay, the first crash is very steep. And then it will go up again, then it will go down again. So as you are moving, you are actually, your slope is actually from this very steep slope become a slanter. Over here, horizontal, then you go up again. So from a steep slope, become slanter and then horizontal and then reverse the trend. But however, you face some negative news or whatever, then the trend go down again. Okay, so over here, this is a resistance. Okay, this is a resistance, and then this is a support. So when you touch a low point, and then when you bounce off from the low point, is a support. You bounce off from the low point, is a support, and then when you bounce off from the high point, this trend line here is a resistance. So this become the upper trend line, and this is a lower trend line. And if you're on a downtrend, you can see your chart, your price is actually moving very nicely in a down channel. It moves very nicely in a down channel. So in a way that if you want to say whether you can predict the price movement, in a way you can see that there's a trend here, because you can see that it is moving within the channel here, if you were to draw trend lines. And then over here, you can see that it is moving along the trend line, these two trend lines. It is moving nicely between these two trend lines. So you can see that you can somehow predict the price when it above, when it touches this resistance, then it moves reverse. Okay. Of course, there's a breakout. Later we'll see. Okay, so this is trend line. Okay, how to draw the trend line? So from one bottom, you see, you want to connect as many touches, as many points as possible. So over here, you just draw one trend line, and then it touches 1, 2, 3 points. Okay. If I were to move this upward, then I will touch here, but then I may not touch here. So the best is that I draw this over here. And the best slope is about 45 degree. Okay, 45 degree. So the slope does matter. Okay, so as you are looking at the 45 degree kind of ascending nicely along the 45 degree line, so it means that this trend is going to persist for longer time. So if you looking at this trend line over here, let me draw. If you are looking at this trend line over here, okay, this trend line is very steep. It is about 60 degree from here to here, about 60 degree. So this is very steep, so it may not be sustainable. So just now we say that as a trend line is very steep, it may not be sustainable. And also, if you have a piece of paper or a pen, if you need to jot down some notes, feel free to do that, because sometimes it is always good to jot down some notes, and then while you are thinking, then your mind can work better. So you can see that the steeper the trend line, it may not be sustainable. So you can see that after for traveling for a while, then it will reverse over here. Okay, it will reverse here. So it travel up here, and then it will reverse. So let me erase it. Oh, okay. Okay, so it will move about 60 degree, and then it go down, and then it slowly move along the 45 degree. As it is moving along the 45 degree, do you notice that this blue line, right, the trend line is longer than this red lines?
Yeah.
That's if I were to draw one trend line here. So that means this 60 degree kind of trend line is not sustainable. It will travel kind of like a short term. Okay, over here it's much longer term. Okay, so this is how you draw the trend line. You can draw the uptrend, and then you can also draw the downtrend. The downtrend also same thing. It touches these few points, and then you connect a point. Okay, so it's very easy. Then the next one is support and resistance. Okay, so when you are looking at this support and resistance, right? So support means something that is supporting the price from falling. Okay, so if I have a support, it means that my price most likely is supported in this level, and then it is not likely to fall below it. So that's a support. And the resistance means that when the price is trying to move up, right, then there's this hindering the movement of this stock price. So this resistance is something that is trying to prevent it from moving up. Okay, so that's a resistance. So then you have this line here. Let me illustrate with you this horizontal line. So if you were to look at this horizontal line, whenever there's a price that it keep on touches it and then it go down, touches it and go down, then this one become the resistance. Okay, it become the resistance. It cannot move beyond that level. Okay, so if let's say the price finally broke up over here, it broke up. Okay, it trying to break, finally it break up. Okay, break out, and then once it break out, right, this line originally was a support line, resistance line become a support. Okay, now when the price fall, and then it will bounce off from here, fall, and then it bounce off from here, fall, and it will bounce. That means it will not go down. Okay, so when it bounce off from this line, right, this line become a support line. So you can see that a resistance line is also a support line. It depends on where you look at it. Okay, so over here it becomes a support. However, up to this point, you can see that bounce, and then finally it breaks through. Then this one become the resistance, and then over here it break up again, become a support. Okay, so this is how you look at the support and resistance. Okay, later I will guide you on how to draw this support and resistance. It's very easy. Maybe I just tell you now. You can look at the over here. Maybe I will show you using the Busan Station. Sorry. This Busan Station, I'm using this Busan Station charts, and over here you can see the trend. The price is moving zigzag. Okay, so then I will try to draw a horizontal line. Okay, I look at the top here. So it is very obvious, like you have two tops here. So I draw a trend line over here. Then I start to look for bottom, see any sharp bottom whereby you have a lots of sharp bottom that seems to be falling at the same price level or the same zone. So I look at it as a zoning. So over here I see that, oh, I have this bottom, and then over bottom. So I can draw one horizontal line over here. Okay, so this horizontal line over here become the support zone. Okay, so over here it becomes the resistance zone. So, and then in the middle you can also look for these are what we call swing. Okay, the swing high or swing low. This one becomes a swing high, then swing low. So over here you can see a sharp point here, another swing high, and then swing low. Okay, so then you can also confidently draw another line along here. So basically, when you look at this chart, you can somehow zone it according to different zone. Okay, according to different zone, like this is the support zone, and then this is a intermediate resistance, and then once you break up above it, then become the intermediate support zone, and then up there you have the final resistance zone. Okay, so if I explain like that, will it be clearer? Like you see it as a zoning, okay?
Yeah.
Support zone and the resistance zone. Okay. So just now, I mentioned about the trend line, right? So over here, you see this swing low, swing low, swing low, swing low, a lot of sharp bottom here. So we can connect this point, and then we can draw a trend line over here. Okay, we can draw a trend line nicely over there. So when you draw a trend line nicely, right, this trend line becomes the support zone of this price movement, of this price movement. And it is not supposed to fall below this trend line. Because when it falls below the trend line, it means what? It means the uptrend has changed or reversed to become a downtrend. Okay, so it was very nicely bouncing off the support zone. However, up to a point whereby there's some bad news coming out, and then this support zone no longer support this price action, and then it will break through. And then once it breaks through, then we call it a trend reversal. So you are changing this uptrend to a reverse to a downtrend. Okay, over here you can see that reversing from an uptrend, now you can draw a downtrend now because it's connecting. Okay, you can connect. You can connect here. Okay, you can connect. Okay, so you can actually connect this upper points here, and then become the upper point resistance line. Okay, so this one become a downtrend. Okay, you can see a downtrend. It's falling down on a horizontal, on a downtrend, and then later, when it stopped falling, then it moved horizontally. And then when it moved horizontally, this one is a horizontal trend, and then finally it broke up again. And when it broke up, and then you change from a horizontal trend to a uptrend. However, this uptrend is only lasts for this period, and then after that, then you broke again, and then it become a downtrend. Okay, so is it okay? So you can practice, because over here, there's a lines here for you to practice. So you can just draw lines and then practice, and then there's an eraser here, and then if you're not happy with the lines, you just erase it off. Erase it off, and then you can erase all the lines. And then you can start drawing again. So it's very fun, because when I started to learn technical analysis, I found that it's more like an art to me. It's very fun. I can just draw lines, and then I can look at there's no fixed rule, and then you just look at it. Somehow I just like to look at the round numbers. You don't have to be exact, like 11.25. You don't have to be exact. Some round numbers is good enough, because those round numbers are psychology level, like $10 or 10 ringgit. 5 ringgit. So these are psychology level. So the important is that you must have a big picture. Okay.
Okay.
All right. Then go back here. Okay. So that's the support and resistance. Then we move on. Significance of the trend line. So the significance for this webinar, I will focus a bit more on the theory side, because as I know that the audience may be a lot of the audience are new comer on the technical analysis, so you may not know much about technical analysis. So I will focus a bit more on the theory side, and so these are the theory behind it. So the significance means reliability. So how reliable is the trend line? Okay, so the reliability of the trend line depends on the length and the size of the trend. So if the trend is a very long-term kind of trend, like 10, 20 years kind of trend, so this trend is very reliable. It's going to continue further. Okay. However, the negative part is that this 10, 20 years kind of trend line, however, if it's violated, okay, as it is violated, it means that you kind of cannot support anymore, and then you broke the support, and then become the downtrend. And this downtrend, right, it will be also a very severe kind of a downtrend, because you have violated a very long-term trend line. Okay, so the downtrend is also a severe case already. Okay, then number 2, the number of times touches or approach. So that was the this thing that I was telling you guys. the number of times. You see over here, if I were to draw a trend line over here, you see I can touch 1 time, 2 times, 3 times, 4 times. So the more times it touches, the more reliable. That means most likely it will also continue for the future pattern. Okay, so it's more reliable. Then the angle or the descent. So this is what I said, angle. When it's 45 degree, it's very nicely. Usually I would like to see 45 degree, which means this the bull run is bull trend is healthy. If it's a 60 degree or very sharp angle of ascent, that means this may not be sustainable. It may be just a sharp rise and then a sharp fall. Okay, it's not sustainable. Okay, so the angle is very important. However, if let's say the angle become weaker and weaker and weaker, then it means that your trend is also weakening. Okay, so this angle also tells you so this is a tip, that means you have to write down. So this angle also tell you the strength of the trend. Okay, the strength of the trend, it means that when the angle of ascent is very fast and steep, it means that this trend is very sharp. There's a sharp rise, and then but however it may not be sustainable. Okay, may not be sustainable. So when the trend is about 45 degree, then this one is comfortable and it's more likely to continue further. However, if the trend is like maybe 20 degree, okay, very flat slope like this, that means it's very weak, weakening trend. So chances are it may turn and then become a downtrend. Okay, so clear enough? Okay. So then the next part I want to talk about is the fan principle, because based on that trend lines, we come to this fan principle whereby we can see the what I meant as in the angles. So you can draw trend lines over here, because over here you can see that the trend is very steep and then sharp. So this is the first fan line or the trend line. Then however, because it's not sustainable, so it broke below and then it become a sharp fall over here, and then after a sharp fall, then the price pick up and then it move up again. Okay, so however when it move up, it is moving more on a gentler slope. Okay, because probably this particular stock, when they have a very good news, right, then the market overreacted, then they quickly jump in and then they buy, so the price jump up, okay, because of overreaction. Then however, then they profit taking, because a lot of people think that, oh, it's not that good, the news anymore, so then they do profit taking. And then when they do profit taking, then people started to, because it's cheap already, so people started to come in to buy again, because originally the stock was originally good. It's just that people overreacted, so they pushed the PE ratio too high or whatever. Then people see the PE ratio too high, then they sell it. And then when they sell it, then the price go down. And then when they sell it, the PE ratio become lower, then it become very attractive. Then people go in and buy again. So now when the people go in to buy, right, then this the ascending, the level of ascending is slower now. It's not like as fast as before, but slower, because they already digested the good news. Now it's like accumulation. Okay, so they just run as the trend goes by, the price just ascending nicely along the 45-degree line. Then however, perhaps there's some negative news again. Over here, more like a macro kind of a, over here it could be micro. That means based on the individual counter, there's a specific news that beneficial for this stock, then it move up very fast. However, over here, the weaker trend here is more like a macro kind of environment, maybe because of the weakening of the economy or something like that. So then you have to see that the trend suddenly, not suddenly, but you know, become people lack of buying interest on this particular stock. Then it become horizontal trend, and then as it become horizontal trend, because as you know that horizontal means it's weakening, right? So then true enough, then you draw another trend line here, then it because this trend line is actually touching this line and over here. So when the price very close to this final trend line, right, it was trying to struggle. It was trying to bounce off above this trend line, but it was not successful. So then it fell. And then once it fell, right, after 1, 2, 3, the third fan line, then most likely this fall is going to be a big fall. Okay, and also because this is a longer trend line that it is violating. So the fall is more impact or more significant over here. Okay. So this is the fan principle. Okay, so this talk about what I said just now. Okay, then the next one, after we have learned about the trend line, the next one we start to look at the chart patterns. So I hope by today you can read the chart pattern, because it takes a lot of experience for you to identify and then to see that, oh, this is double top, this is head and shoulder, and this is W or double bottom. Okay, so it takes time for you to familiarize yourself with the different types of chart pattern. You just have to go through as many charts as possible. Okay, you can just go through as many charts as possible, and then you start to look at the real charts and see what's the patterns over here. Okay, so over here, can you see what's the pattern over here? Okay, I'm sure some of you have seen the pattern over here. You can see like this one is a big double top. Okay, and then where else? Over here you have a head and shoulder over here. You have another head and shoulder over here. Okay, you have another head and shoulder over here, and over here you also had a W. Okay, it's supposed to be a W building a bottom, and then if this bottom is strong enough and supposed to push this price further, but however it reversed and then become down, and then so this whole thing become a big double bottom, big double top. Okay, then let's look at here. Okay, so this is a summary. Okay, later we go into detail. Okay, so this is so for chart pattern, the basic theory is that you will have two types of chart pattern. One is a reversal patterns. The other one is a continuation patterns. So a reversal pattern, it means that at one glance you look at the chart, right? You can see that the top part, okay, or the bottom, you see a pattern there. Okay, so for example, you see from the top here, oh, there's a double top or head and shoulder. So then it's become like it is a reversal pattern. Okay, so whenever you see a double bottom or a double top, head and shoulders, reverse head and shoulder, and rising wedges, falling wedges, so these are the reversal patterns. Okay, so that means the trend from uptrend is going to be reversing to downtrend. From downtrend become uptrend. Okay, reversing. And what is continuation pattern? It means that it is a continuation of a bull run, or it is a continuation of a bear trend. Okay, so for example, you can see that the price is moving up, and then moving up, and then it will consolidate, because you cannot move up forever. I haven't seen a chart that move up forever and forever. You will have some resting time. So this resting time is for people to take profit. Okay, because the price has moved up too much, and then people time to take profit, so it will move horizontally. Then it's called consolidation. So after a while, after people taking profit, and then new buyers will come in again. Again, the price move up again, and then after a while, the price too high again, then profit taking, consolidation. Then move out again, and then consolidation, then move out again. So you can see that this part here, okay, this pattern here is this pattern. You can blue flag, bullish pennant, bear flags, and then bearish pennant. So these are the patterns of a continuation trend. Okay, the pattern in the middle of the pattern, or in middle of the trend. Okay, so let's go through the individual chart pattern individually, and then we'll go a bit more about the theory part. Okay, so for a rectangular chart pattern, it means that you have a upper, okay, you have a upper, upper trend line, and then you have a lower trend line, okay, and then prices will move within the channel. So it is a horizontal trend over here. It's very clear cut. So the upper line is a resistance, lower is a support, and then okay, upper here the resistance, support, and then when you break down the support, it become a breakout. When you break above it, it's another upside breakout. This is downside breakout. Okay, so when you see people say, oh, it's a breakout, breakout means that it break out the trend line, against the trend line. So you have a horizontal trend, then it break down. Okay, so it's constructed by drawing two horizontal lines marking the top and the bottom boundary of the trading, and maybe continuation or consolidation, rectangular. That means it's usually when you see rectangular, it has to be consolidation. Okay, consolidation. And then when it is consolidation, enough time for it to rest, enough time, then no more bad news, then it will go up again. Okay, the market is like this. So in the absence of bad news, right, the market tends to move horizontally, but to a upward bias. Okay, in the absence of bad news. So if you have no bad news and then just a normal day-to-day, so the most likely you see that prices move slowly but steadily on the upside. But once you have a bad news, then it will reverse. Okay.
Okay.
So volume is getting lower as the rectangle is forming. So as you are forming, then you also have the volume bar over at the bottom here. So maybe I can show you the volume bar. Okay, volume bar. Okay, over here you can see these are the volume bars. Okay, the volume bars. Okay, so when you read the chart, you have to read the price. This is the price action, and then followed by the volume bar. Okay, all these are the price action. Get back to the chart here. Okay, so volume is getting lower as the rectangular is forming, and followed by an expanded volume at the breakout. Okay, so then that means that when it is horizontal, it means very boring. The whole market is very boring, or the stock is very boring. People are not interested in the stock. So that's why the price move up and then hit the resistance, then move down, hit the support, and then move up. It's moving in a kind of predictable. So that's why the volume is also very limited, because I'm not interested in this particular stock. So however, when there's suddenly a bad news or a good news, then it will break out. Okay, break out as in on the downside or in the upside manner. Okay, so this one is a rectangular chart pattern. Okay, head and shoulder. So head and shoulder is built with one head and then two shoulders. You have the left shoulder and then the right shoulder. So then this one is a breakout point. Okay, you draw a neckline. So this is a neckline. Okay, when you break below the neckline, then it's a breakout. Okay, we call it a big breakout. So sometimes head and shoulder neckline violated but did not continue further. So this one is the failed head and shoulder. So sometimes we do have failed chart pattern. It's not always that you have this chart pattern and then sure the outcome will be exactly as what you predicted. It's not necessarily. Sometimes it does have a failed chart pattern. So when it has a chart pattern, how do you know? You draw trend line. Okay, because when it's supposed to come down, but it didn't come down, and then you can see that your trend line has a higher low. The bottom, the lower point, right, is every time when it hits the bottom, then it bounces back. It hits the bottom, it's bounce back. But you can see that this bottom, right, is getting higher and higher and higher each time. So that means this trend is reversing. Okay, it's no longer downtrend, but going upward. So then you can see that this chart pattern is a failed chart pattern. Okay, it didn't go to what you expected, but it's reversing. Okay, And also the volume is also confirmation, because if you have seen that it's a breakout, it's always good to see that the volume is rising, so that will confirm the breakout. Okay. Now this one is measuring the target. So a chart pattern, we also need to measure the target. The target meaning, okay, for technical analysis, one good point or one good thing about technical analysis that I like is that I can actually predict how far the price will go based on this target measurement. So for example, I have this head and shoulder over here, 1, 2, 3. Okay, one head and then two shoulder. Then I can see that this neckline over here, there's these two bottoms. So I draw a trend line over here to connect these two bottoms. So then this one become my neckline. So you just look at it as one head and then with the neck here. So this neckline. And when the price break down this neckline, and it's called a breakout, downside breakout, then this is a violation, okay, of this chart pattern. It means that the trend is going to reverse from this uptrend to a downtrend. Okay, so true enough, then you have a big fall. However, if people who doesn't know about technical analysis, they want to know how far it will go. People will ask me how far it will go. Then I always tell them, okay, you take the neckline, and then you take the top part, and then you measure the distance between the maximum point and the neckline. You measure this distance, okay, and then you project this distance over to here. Okay, so that means I must have the same distance here to this same distance. And then you draw another line. So then this line will be your targeted price. So I said, okay, according to the technical analysis, the first target will be 760 points. Okay, so that's the first target. However, it doesn't guarantee that when it hit the first target, it will bounce back. Okay, sometimes it may break the first target and then it move to the next target, and the next target will be the same distance you projected down here, and it will be the same distance, so it will be another bracket down, another level down. Okay, so that's how we measure. Okay, so the technical analysis part, this is what I like about it, which is you can measure the price target based on the chart pattern. Okay, and this is the downside. So for this particular chart, it didn't reach the 760. In the end, it reached about 780, and then it bounced back. Okay, so when you see that, okay, so this is a tip. So based on my experience, whenever I have say the word tip, it means that it is based on my experience, and then you have to write it down. Okay, so based on my experience is that whenever you see that this is supposed to be a target and then it didn't hit the target, by right, sometimes it will most likely hit the target. Okay, however, if it didn't, it falls short. Okay, before the target, it already bounced back. It means what? It means that this particular moment, the trend is reversing very fast. That means it is not as bad as you think. It will reverse, and then the next move, the up move, could be very powerful, because people are changing their mind. They don't want to sell anymore. They want to get in, and then they want to buy, and then they want to get into this position. So before they even hit the 760, right? Already people are started to buying in. This shows what? This shows that people are confident with this particular stock or market. People are confident because I don't want to wait until 760. I want to buy now because it's cheap already. So that if one person thinks like that and everybody thinks like that, everybody will buy before 760, and then which means that this particular situation is not as bad as you think, and then the trend will reverse very fast. Okay, so this is the tip. Okay, then next, reverse head and shoulder. So just now we saw the head and shoulder was in the top part. Then it is also a bottom. You can also see a bottom over here. Okay, bottom meaning that it's falling, the price is falling. Then it form one low here, one low point here, and then okay. it formed one low point here, and then it formed another low point, and then it formed another low point. So as it is forming, then it formed three bottoms here. Or if you look at it, you can either call it three bottom or head and shoulder, because it's a head with two shoulder. Then you draw a trend line, and then it will break up, and then that's a upside breakup. Okay, so then you know that quickly you have to, if you are selling or you're waiting, quickly you better get in. If you are waiting for the chance to get in, you buy in from here. Another way of looking at it is that you buy in here, or you wait, you don't buy in first, because sometimes you will break out and then a false breakout. How do I know whether it's a true breakout or a false breakout? So then the next tip is that once it break out over here, right? Once it break out over here, then you will have a wait. Okay, you wait for the price to retrace back. We call it the retracement. Okay, so the price shot up and then it retrace back. But when it retrace, right, we have to make sure that it didn't fall back over this trend line again. It will retrace up above this trend line and then you bounce back. Has to bounce back. Has to bounce off from this trend line. Okay, the retracement has to bounce off from this trend line. Then it's a confirmation. Okay, it means that, okay, confirm, it will not break below this, because the first bounce, it means that it will not break below this trend line. So it's confirmed. Then you buy from this instinct or this moment. Okay, so first breakout, you wait and then wait for retracement, then confirm, then you buy in. Okay, so this is another tip. Okay, you buy at the retracement. However, I do see that when it's a very bullish market, it go all the way up and then retrace only a little bit and then go all the way up. That means you miss the boat. So sometimes you have to buy at this point. Okay, it depends on how you look at the stocks, okay, whether it is a good buy or not. Okay. Then a double top and double bottom. So just now we had a head and shoulder. So now it's a double top, double bottom. Double top, double bottom consists of this two peaks. Okay, two peaks. Mm-hmm. So for these two peaks, you have a valley. So this lower point, we draw a neckline. So this neckline is a determined point. Okay, either you break it or you don't break it. Okay, if you break it, for people, for traders who are looking at trading for the chart pattern, when they see double top or head and shoulder, they are very happy. So they have to wait. Okay, you are happy, but then you still have to wait. You have to wait for confirmation. So when the price finally broke, and then the confirmation is that it will rebound. Okay, because sometimes we're oversold, then it will rebound. But when it rebounds, right, it didn't pass through this neckline. Okay, so if it didn't pass through the neckline, it's going to come down again. So it's like a law of gravity. You throw a ball up to the air, it didn't go further up, stagnant, it will come down, reverse, and it will come down. So for technical analysis, you can look at it as bouncing the ball. Okay, you hit the ball onto the floor and then it bounces up. Okay, so that means the floor is a support. Okay, so then usually the second top is lower than the first top. Okay, the rally, I'm talking about the rally. So the second top is, if its second top is lower than the first top, it means what? It means that the buying interest is, okay, let me explain the psychology behind it. Okay, when you are breaking up over here, when you are ascending nicely over here, right? When you're ascending nicely over here, then it means that people are buying this particular stock. Okay, people buying. Then suddenly after you bought it, and then the PE was pushed too high, then overvalued, then people started to sell it. Okay, they take profit. So when you start to take profit, then the price will move down. Okay, now when you move down, then like what I said, okay, because psychology-wise, the news digested, bad news digested, and then people look at it, it's cheap enough, then people go in again. Okay, the market is always like that. You buy because good news, and then you sell, then bad news, and then when nothing, the market is quiet, and then when people are lack of confidence or whatever, smart investors are actually accumulating, then they will start to buy in. Okay, so when they buy in, however, they look at the situation, okay, the actual situation is not improving. So then the second rally could be lower than the first rally. Okay, so the first rally is high, then the second rally is low. Okay, but however, I do see that sometimes the second rally is higher than the first rally, and then it go down like that. Okay, so it depends. So of course, the most important thing is still the trend line. Once you draw the trend line, you will not be guessing anymore. Everything is facts and figures. Either you break the trend line or you don't break. As long as you don't break, it's still uptrend. Okay, so this is about technical analysis. It's very logical. Everything is facts and figures and logical thinking. So you just follow the trend line. It didn't go through the trend line. You just assume that it is still uptrend. Okay, it is not reversing yet. Then so this one talking about the measuring the objective. So because if you are looking at this price target, you have one lower peak and then one upper peak. So which one would you choose for measuring the price target? So you choose the upper one, the maximum one. So you draw another line here. Okay, draw one line here. Then you draw one line. So the distance, then you project this distance over here. Then that will be your price target. Okay, you draw using the maximum height of the chart pattern. Okay. So you also have to have the bottom. Okay, bottom is the same thing. The rationale is the same. So the double bottom mirror image of the double top. So the volume at the second value should be lower. Volume should expand at the breakout point, and the target projection is same as the double top. Okay, so then this is to say that when you are having a double bottom, that means it's the price or the sentiment is very weak. Okay, it is coming from a sharp fall. The market has been falling for quite some time. Then now it is consolidation. It's no longer falling anymore, so it's consolidation on this horizontal line here. Okay, so you can see that it is consolidation on this horizontal line here, assuming that it's falling from here. Okay, falling all the way down. Okay, then it stopped. It didn't fall further. Then it bounced up. Okay, then it go down again, and when it go down, it didn't break below that, so it's still bouncing off. Okay, so then you are actually consolidation along here. Then you break out. Okay, so over here, when you break out, you must see that the volume. Okay, it's very important. Now you must see the volume increase. Then this confirm the breakout. Sometimes you have a false breakout whereby you saw the breakout, but then the volume didn't support it. So you can see that it's very fake. Okay, so probably somebody is manipulating the stock or whatever, because of there's not much of a volume to confirm the breakout. Okay, so that's why you need to look at whenever you have a breakout, you need to look at the volume. Okay, then the broadening formation, you can see that you can draw a line because it's moving higher and higher. Okay, sometimes over here it's over lower and lower, so you have a broadening formation. So this broadening formation also a chart pattern. Okay, so same thing, either you have a upside breakout or downside breakout. Over here is a downside breakout. Okay, so triangle, whenever you see the psychology behind it, as in okay, so the psychology is that, okay, when the price is from lower all the way to up, okay, low all the way to up, and then it go down. When it goes down, people think that, okay, not much of a bad news, and then now it's cheaper now, then people go in again. Okay, however, when people go in, right, it hit another high over here. Okay, it is always important you look back at the swing high and swing low. So over here you look at the swing high and then the swing low. Okay, so when you are moving on this stretch over here, you pass the swing high over here. So whenever you pass the swing high, it is bullish. Okay, so however, if you cannot pass this swing high, you reverse, it is bearish. So tip number, I don't know which tip is it. Okay, the next tip is that you look at the swing high and swing low. Okay, you look at the swing high and swing low. So whenever the price pass through the previous swing high, okay, it is bullish. Okay, it is bullish. Whenever the price fall below, okay, now this fall, right? This fall is below this swing low. Then this low is lower than this. It is bearish. Okay, so whenever you have a up here, it means bullish, and then whenever you have down here, it means bearish. So for this particular chart pattern is that you see that, okay, now I'm getting a higher, over here it's higher high, but over here starts to have a lower high, okay, lower high. But the bottom still maintaining, okay. However, the high over here is lower high and lower high. Each high is lower. The psychology behind means that people are not buying into this stock. Okay, they are not confident. Before they hit the previous high, they quickly sell already. And then before they hit the previous high, they quickly sell already. That means they sell before the previous high. So that means that shows how not confident they are. So that means this stock is not promising. Okay, so then true enough, it hit the support and then it broke down. Okay, so sometimes it's good that you know the psychology behind it. Okay, why it is having a lower high, and if the bottom is maintaining, it is still okay, and then after a while, then it will break out. Okay, so then this one is also another breakout. Okay, let's see more examples. Okay, let's see the theory part first. So two types of triangle. You have a symmetrical and a right angle. Okay, later I'll show you what is symmetrical, what is right angle. Okay, this one is a right angle. You see, this is a 90 degree. So this is a right angle whereby this support zone is a horizontal. Over here, you are having a symmetrical. Okay, you see, symmetrical meaning that this low is a lower low, and then you have a lower high, but then over here, this low. I mean the high, the low point is higher actually. Okay, the low point is higher. Okay, you have a higher low and then a lower high. Then you are cornered into a very narrow channel. Okay, over here. So whenever your price action is cornered into a narrow channel, it means that the market is without any direction. Okay, so whenever you see any chart pattern, and then when they are cornering into a somehow a low volatility kind of a movement, okay, so that means the market sentiment is that they do not know what to do. They don't know whether to buy or sell, so they're just maintaining it. Okay, so it's lack of direction. So therefore, they are just waiting for a news, for an opportunity for this to break out. So this opportunity could be an upside news or a downside news. Could be a positive news or a negative news. Okay, so therefore, when you see a symmetrical triangle, the breakout, right, it could be either way, because people are actually indifferent. They do not know whether it's a good news or the bad news. So they're just waiting for the news to happen. And then when the good news happens, then they will break up upside. And when bad news happens, then they will break down. So when you see a symmetrical triangle, right, the breakout can be both ways. Okay, depends on the news. However, when you see a right angle triangle, the chances is it will be a downside. Okay, why? Because you see, you have a lower high. Whenever you see you have a lower high, it means what? Lack of confidence.
Mm-hmm.
Whenever you see you have a higher high, you got confidence to continue. Okay, so the trend is up. And then when you have lower high, it's a downtrend. Okay, so it is more reliable. The breakout occurs at the half to 3/4 of the distance between the beginning of the pattern and the apex. So this is what I meant over here. Half to 3/4, then break out. Because sometimes it's moving and then you don't know when to break out. It's around here. Half to 3/4, then it will break out. Okay? Okay, so this is symmetrical. So symmetrical triangle constructed from two converging trend lines that join a series of declining tops and rising bottoms. So the volume is usually low as low as it's usually low as the pattern is forming and expanded on the breakout. The reason why low, can you tell me what's the reason why low? Just now, as I said, as they are cornering into a very low volatility manner, right? It means that people are not really, they do not know what to do, lack of direction. That's why the volume is low. Okay, they do not know whether to buy or to sell. Then when the news come out, then the volume will pick up. It's either on the positive news or the negative news. Okay, in general, more reliable than a right angle triangle in general, right, is more reliable than the symmetrical triangle, because right angle is quite clear that you see the trend is weakening. Okay, so it is constructed with one line that is horizontal or right angle to the price axis. So the horizontal line is the support or resistance line. Okay, so it could be horizontal here, and then it could be the bottom is rising. So if you see that the bottom, right, although every time when you hit this resistance, then you fall back, and then when you fall back, you go up again, hit the resistance, and you fall back. However, this fall back, right, is higher low. You see, it's higher low. Then you go up again, and then you go fall back. Then when you fall back, it's also higher low. So every time people they do not want to wait until the previous low. Before the previous low, they quickly go in and buy already. So that means they are what? Confident. Okay, they are confident that this share is moving up. So that's why they don't want to wait until the previous low. They will buy before the previous low. So that's why you have a higher low. So it is kind of bullish signal over here. Then true enough, then it will break out at the horizontal line here. This one is a breakout at the horizontal line here because of this falling, lowering high. Okay. So volume is low as the trend is forming and followed by an expanding volume on the breakout. Okay, so in any chart pattern, right? In any chart pattern, as the chart pattern is forming, right, the volume is low. Okay, or rather, you can see obviously whenever there's a breakout, the volume is always higher than during the formation of the chart pattern, because because everybody, like technical analysis, everybody, the traders, they're all looking at the technical analysis. So of course they are waiting for this golden opportunity, the chart pattern, because people are trading on the chart pattern. So whenever they see that this chart pattern is about to form, right, everybody is patiently waiting. So finally, when this chart pattern is forming, right, then everybody will rush in to buy or to sell. Okay, so then the volume will spike up. Okay, so you can see the volume increase is because of the people, the number of participants coming into the market to take advantage of this market or the stock. Okay, a failed triangle. So sometimes you have a failed triangle. So failed triangle meaning that you see that this is a weakening sign, right? But however, it didn't break down, it break up. Okay, so sometimes it does happen like that. So when it does happen like that, it means what? It means that you could have a positive news come out, and then people will just buy. Okay, so sometimes you have a failed triangle. Okay, so this one is a summary of the price pattern, whereby it says that the price pattern, right? Whenever you look at the price pattern, you look at the significance. Okay, significance, that means how big is the chart. Okay, how big is the chart? So let me show you again. Okay, now this one is from 2013, 2019, okay, about 6 years. So this one is a big chart pattern because it's a spanning of 6 years. However, you look at this one is about two years pattern. Okay, so 2 years pattern, and then followed by a violation over here. This is a neckline, violation roughly. Okay, you can move down further. Okay, but anyway, I click here already. So actually you can move down here. Then there's a violation of the neckline, then the price will fall. Okay, because this chart pattern is only for 2 years, so the fall is only like one year plus or so. Okay, fall bearish doesn't mean that it is down all the way. Bearish, it could be down or it could be horizontal, as long as it is not up going up, it is called a bearish trend. Okay, so horizontal and the downtrend is considered bearish. Okay, so over here, the horizontal trend is about one year plus. So that means the significance of the chart pattern will determine the price action of the outcome. So for example, you see maybe over here a very small chart pattern. Okay, a very small chart pattern. Okay, over here. Okay, over here, small chart pattern. Let's say a double top over here. Oops. Okay. Okay. Let's say over here. Okay. Maybe a few months of a double top chart pattern. Then you draw a neckline. Then the fall. Okay. And then also another tip. Over here, actually, if you to look at the price action, over here, this is the neckline, right? If you look at the distance, right, this fall is actually about 2 or 3, 2.5 target. That means this is one bracket and then this is another bracket, 2.2 a bit more than two targets over here. So this one is a very bad fall. Okay, but actually, although this is a very bad fall, but the duration is actually from November to exactly 1 year. Okay, and then this one is October, November. So this is 1 year plus, but the fall is about 1 year. So the fall is always, the fall is shorter than the duration of the chart pattern over here. Okay, over here you can see another chart pattern, then it fall. However, this fall is very short. Okay, so the smaller the chart pattern, the fall is also a short term. So that means what? That means the chart pattern, the bigger the chart pattern, it will tell you the duration of the fall, of the impact of the outcome. Okay, so if you have seen a small head and shoulder, then it violated the small head and shoulder. The head and shoulder maybe 3 months, maybe the fall is about 6 weeks or 5 weeks. Okay, then it go up again. So therefore, when you look at to study the chart pattern, right, you have to look at the size of the duration of this chart. How long to form? If it takes only 1 month to form, then when there's a violation, the effect is much smaller. And then especially when you're looking at a 1 minute chart, 5 minute chart, or 15-minute chart, then you see a double top, double bottom. So all this double top, double bottom, all this duration is also very short term, because you are looking at a very short term chart. Okay, so if you're looking at 10 year, 20 years, and then you see a big chart pattern forming. So when this big chart pattern violated, then the impact will be very significant. It could be a prolonged kind of a downtrend. Okay, so this is something that you need to bear in mind. Okay. Then you have the measuring implication. This is what I said, the target. Okay. Then the confirmation is based on the volume or retracement. Okay, the confirmation, this one is when they pass through the line. Okay, so another confirmation is this 3% of confirmation. Okay, 3%. That means the price, for example, it fall below the trend line. Fall below the trend line about 3%, that is a confirmation that is a downtrend. Okay, because if you do not want to wait for the retracement, right, then this 3% rule you can apply. Okay, so then the volume plays a very important, especially during the chart pattern and during the breakout time. Okay, so the application of this chart pattern is that, okay, first in the beginning, I said that application that you have to apply using the trend line. Chart pattern has to apply using the trend line, and the trend line can be what you draw over here, or it can be the moving average. I like to use moving average as the trend line as well. And popular moving average is 20-day and the 200-day moving average. So you can see that this one is a 200-day moving average. in a long-term kind of a trend line, it moves nicely above this 200-day moving average. Okay, then when it's below this 200 moving average, then it's a downtrend. Then it move up again, and then currently today we just broke above the 200-day moving average, so which is a positive. Okay, so so that means that this chart pattern you have to use together with the trend lines, and then you have to look at the long-term chart. So whenever you first, like for example for me, the first thing I open up a chart. Okay, I open up a chart, I have to go with a far distance. That means I go right at the back. I will expand all the way to 10 years, maybe 10 or 15 years. I want to see a big picture first. Okay, I want to see what is the macro view of this chart first. Then after that, then I will zoom in to see the closer months or closer years. Okay, so the very first thing is that you look from far, then you go in. Okay, from macro to micro. You have to know what's the big picture first. So technical analysis, I use that for long term, not necessarily short term, because I like to see the big trend. Then chart pattern you can apply with the gaps. Okay, so for example, you have this head and shoulder, and then it falls, and then there's this gap over here. Gap means that gap down. That means this day, the next day when the market reopened, the market straight away transacted. The very first transaction is a much lower price than the previous closing. So there's a gap over here. Okay, so that's a gap down. So over here, you also see a chart pattern over here. Okay, this is a horizontal. And then once it broke this horizontal neckline, then another gap over here. Then it go down further. Okay, so this gap is also a confirmation that how bearish the situation is. Okay, you can have either gap up or gap down. Gap up means very bullish. Gap down means very bearish. Okay, then you can also apply this chart pattern onto the indicators. So now you see that you have a RSI. So for RSI over here, you have a up and down, all the lines here. So you can also draw trend lines. You see there's a multi-top over here. So you just draw a trend line and then it go down. So it go down and then you refer up and then see what's the action. Oh, you see that, oh, there's this 20-day moving average. It broke also the 20-day moving average, and then you can draw a trend line. It also broke the trend line. So then you can see that, okay, it's going down. Okay, so you can apply this chart pattern in the indicators. There's so many application of this chart pattern. Okay, so now we do a recap. So today, okay, if you still remember the 3 basic things about how you apply this chart pattern. Number 1, you have to look at the charts. Okay, the chart pattern. Then number 2, you look at the trend line. Okay, number 3, you look at the support and resistance. Okay, so the support and resistance just now, okay, support and resistance, basically you look at the swing high and the swing low. Swing high, swing low, swing high, swing low. And this swing high, swing low will give you a pretty impression of what will be the support and what will be the resistance. So over here, you can see that the swing low, swing low, swing low. Okay, so you know that this is pretty strong support over here. Okay, so repeat now, chart pattern, okay, together with trend line and the support and resistance. And these 3 ingredients are the basic foundation of technical analysis. However, if you want to know about like indicators, by all means, okay, because indicators are, to me, I would think the indicators are kind of lagging indicators, because what is the very fast price action, the very first instinct that you can see is actually from the trend line. Whether you break the trend is very clear. Whether you break the trend line or you don't break the trend line is very clear. Or you move, if you are moving along the trend line channel, that means you are still the trend is still persists. However, once you break out, that means the trend is reversing. So it's very clear cut. Okay, You just need to draw lines. However, when it comes to the indicators, right, either a Bollinger Band or RSI or stochastic, all these, right, is based on the calculation of moving averages or things like that. All these are lagging already. Okay, the price action are lagging, and some of them are based on most of them are based on the end of the day prices. So it's lagging. So if you really want to know what is the action now, you look at the 5-minute charts, 15-minute charts, half an hour chart. Then you can see that those are the real action going on. Okay, so I hope you enjoy today's session, and I hope you can apply this technical analysis on your trading, because it is very important to know about technical analysis, especially if you are trading on a short-term basis. However, if you are investors, technical analysis is less important. You focus on the earnings of the company, which is more important. Okay, so that's all for today's session. And you have any question? Okay, Sumita.
Okay, hi Pauline. Yeah, we have a few questions. So I'll just take back the presenters first. 1 minute, yeah. Okay, so for our first question, we have, besides the candlestick and pattern trend line, does RSI, MACD, and volume chart help in deciding to trade in a particular stock?
So you're saying, can you repeat the question? Besides the pattern?
Besides the candlestick pattern and trend line, does RSI, MACD, and volume chart help in deciding to trade in a particular stock?
Yeah. As I said, if you want a very real-time kind of action, the trend line is the best. However, if you want to include the RSI, so this one is like you want to know what is the overbought and oversold. Of course, this is also important. It's just that it will be a different. That means you are either looking at overbought and oversold on the after the day, end of the day. That means it is not as urgent as a day trader. As a day trader, if you you have to look at the trend line, is more accurate, because the indicator, as I said, is already a bit lagging already. Yeah, but however, it does help, because different indicators will have different signals. For example, the RSI will be the overbought and oversold signals. Yeah.
Okay. So the next question, how to avoid false breakout?
Okay, so just now I said there are two ways, right? So one is that you wait for the price will retrace back. Okay, so when the price broke out, and then the price drop. Okay, so let's say it's a downside breakout, so the price drop. So when the price drop, right, it will not drop forever. It will rebound. Okay, so you have to look at the risk, this rebounds, right, whether it will pass through the neckline. So if it didn't pass through the neckline, it reverses again, and that will be a confirmation. Okay, so this is number one. Then number two is a 3% rule. 3% rule meaning that the price will break out, and then it will travel. The price will move further for about 3% of the value of the price. Okay, then there's a confirmation. So 10 ringgit, 3% maybe is a 3 cent. 3% is a 30 cents. Okay, yeah.
Okay. So the next question, if weekly chart is downtrend but daily chart is uptrend, what will you do? Buy or sell?
If again?
If the weekly chart is downtrend but the daily chart is uptrend, what will you do? Buy or sell?
Okay, so the daily chart is uptrend, the weekly chart is downtrend. Okay, so are you a short term or a long term, or it depends on your time frame. So if you are short term trader, investor, you look at the daily chart. Okay, so if you look at the daily chart, it is showing a 20. It's a positive. Then of course you have to go along with the short-term trend. Okay. However, if you are more on the medium-term trend, you look at the weekly chart. So weekly chart telling you that it's bearish, so better you stay at the sideline. Wait until the weekly chart break out, then you go in again as a long-term investor. So it depends on your time frame. Yeah.
Okay. So the next question, when drawing the trend line, do we need to include the long shadow?
Which long shadow? What do you mean by long shadow? When the drawing, oh, you mean the candlestick, the long shadow?
Yes.
Yeah. So it depends. For me, sometimes, most of the time, I don't include the long shadow.
Okay.
Because that one is like a intraday.
Oh, okay. Okay.
The long shadow is an intraday, so I don't.
Okay. So for the next question, how to get good news or bad news fast? Is there any portal or website?
I usually go to i3 Investors and Busan Marketplace, and then CNBC News. These are the three websites every day I go in and look at the news a few times. So yeah, because when you're in this industry, you really have to keep an eye on what's happening. So I will always go to, especially the i3 Investors, they have a forum. Then for this forum, you can look at what other people are thinking also.
Oh, okay. Okay, so for my next question, how to know the volume is okay or not when it breaks out?
Okay, you look at the bar. Can you see my screen now? Okay, you look at the volume. You look at the volume bar.
Wait, Pauline, I just make you presenter again.
So I have to
You
share my screen.
Yeah.
Oh, okay. Okay, so you look at this volume bar. Oops. So these are the volume bar. Okay, so when you see that the volume bar is spike, that means it's higher than the rest of the average. So then these are confirmation. So you see that there's one confirmation here, because this volume bar spike up and then the price move up. Okay, that's one confirmation. Then there's one confirmation. This is very high volume bar. Okay, so then the market move up. Okay, so then this spike in this volume bar are confirmation. That means they are above than the average.
Okay.
Yeah.
Okay, so for the next question, 3% continuation after break refers to stocks or index, because 3% for index is a lot.
Yeah, usually it's based on your experience. This 3% rule is just a theory. So it depends on your experience. So certain times, right, I will not wait for 3%. I will wait for like the index. So for example, the KLCI index, at any one point, right, if it move beyond 10 points, it is considered high volatility. And if it's moved 20 points, it's a confirmation already. So anything that for KLCI index, usually I will look at 20 points. Move above 20 points is a confirmation. Then for the individual stock, then you can see whether it's a 2% or sometimes it's even higher or lower. It depends on individual stock. Yeah.
Okay. So for the next question, based on your experience, what is the support and resistance level of KLCI now?
Okay, so for this week, my support is 16 support is 1660, and then my resistance is 1690. So in fact, today the index has break above my resistance for this week. So which is a positive news. That means it has broke above the 200-day moving average. So now I just want to see that whether it will break above the 200-day moving average, and then when it retrace, right, it will have to retrace above this 185 points, 1685 points and above. Then it's a confirmation. Okay. However, if it broke above this 200-day moving average and then it come down again, then it's a fail breakout. So we will have to observe whether there's a confirmation or not. But today is a breakout for our KLCI index.
Oh, okay. So for our next question, which pattern has the highest probability of success?
Head and shoulder. I like to look at head and shoulder. Yeah, it's always it's much reliable than the double top.
Okay. Okay, so for our next question, the resistance and support line are drawn after the fact. How are we sure to know about the next move, as the market is not always follow the pattern?
Okay, so for example, you look at this, right? If I have 2 points and then I start to, let's say you do not know what is happening over here. This two line, you just draw a line. And then somehow you see that sometimes it may overshot, and then somehow it may fall short. But then somehow this line, right, it moves kind of, it is kind of a good support zone for this particular chart. So as long as you have 2 points, then you connect, and then you have to make sure that when you connect, you are not like too flat or too steep. Okay, it's like a gentle slope. Then it will be quite predictable, because usually the market will move along a predictable or like around 40 to 45 degree kind of a slope. That's for the KLCI, but then for US, they kind of going more on a steeper slope.
Oh, okay.
Okay, so it depends on the market. Yeah.
Okay. Then for our next question, for slanted head and shoulder neckline, how do you estimate the target price?
Actually, I draw slanted. Actually, you have to draw horizontal. Okay, the head and shoulder, you have to draw a horizontal.
Okay.
Yeah, that I just drew a slanted. Okay.
Okay.
But have to be horizontal.
Okay, so for the next question, for day trade, what is the best time frame for technical analysis?
You mean the chart? Depends on your strategy, actually. For me, I'm looking at 5 minutes, 15 minutes, and half an hour. I look at these three charts together. But some people, they look at even a lower degree, lower level of that means even shorter time frame. Okay, so it depends on your strategy. So different people will have different strategies. So there's no right or wrong. Yeah.
Oh, okay. Okay, then on to the next question. Is it the longer time frame makes the pattern more significant? Is the chart pattern significant for intraday trading?
Yes, because for the intraday, for the even 5 minutes, you do have a chart pattern. Let me see.
Oh, okay.
Let me see. See, I have a 5 minute charts here. Even this 5 minutes chart, you do have a chart pattern. You do have chart pattern over here. Okay, you do have. So all these are chart pattern. So chart pattern occur as long as you have candlestick, then you can construct chart pattern already.
Okay.
So see, you see the chart pattern.
Okay, so on to the next question then. If the RSI indicates that overbought, should we sell it?
Okay, for RSI, right, I will usually tend to look at the oversold. because I want to buy. I would not look at the upper band as a overbought, because for RSI, sometimes you see that it hit the overbought zone, the price keep going up. Okay, so most of the time. So therefore for RSI, I will focus on buying and not focus on the selling.
Okay.
Okay.
Okay, so for our next question, do we need to look into different indicators at the same time before deciding on trading plan? If we need, what are the...
Okay, so for new beginners who are into the technical analysis, right? They will tend to read a lot of indicators. Okay, so my advice is that, okay, for maybe you can do an experiment. If you do not look at the indicators, right? You just look at the focus on the trend line. Will you be more clearer? Okay, so you see that maybe you can be more clearer if you do not look at the indicators, because there are so many hundreds of indicators. How do you know which one to use? And they are all lagging indicators. So therefore, you have to focus on the trend line, and then your view is clearer. And you only look at the indicators. For example, you just look at the moving average for the support trend line, support and resistance, or you want to see when is a cycle low, like for example RSI. I want to know when is a oversold point, so that I just want to buy some blue chip stock. I just want to buy in some blue chip stock. So I look at the RSI. Whenever oversold on the weekly chart RSI, I will go in and buy some blue chip stocks. Okay, so indicators for me are for other purpose, but for trading, right, I will focus on trend line. Yeah.
Okay. Okay, so for our next question, how many times will the support and resistance be tested before breaking?
Okay, the theory, right? Theory is that after 3 times, the 4th time it will go through. That's theory. But in practice, you see it could be anything. 2 times, 3 times, 4 times. There's no straight rules. Yeah, there's no straight rules.
Okay. So if it breaks at 1685, how long will the bullish be?
It depends on the retracement. Okay. Another trick that I want to share with you is the retracement part. So for example, wait. Okay, so for example, so whenever you have a fall, okay, whenever you have a fall and then you have a bounce, especially when you are in a bearish zone, okay, whenever you are have a fall and then if you are in the bearish zone, your rebounds is very meaningful to me as a trader, because I will have to see your rebounds, how high you can bounce. Okay, so if you have fallen for some times and then you have a rebound, if your rebound is very sharp and high and then you just rebound up, that means your momentum is there. However, if your rebound is very weak, you just fall, you fell very hard and then you rebound and then your bounce is only a little bit, and then the chances are is the uptrend is not going to sustainable. So for now, I just see that it's broke the 1685, right? I need to see for the next few trading days, see how well it maintained above this level, and that will determine the next month or so movement. So next few weeks are very crucial, because as we know, the trade talks seems very too good to be true. But as investors, I've been in this market for too long. Whenever things are too rosy or too good, I always play the defensive side. Okay, so I always have this contrarian thinking. And when the market is doom and gloomy, I will be reversing. I will be buying. So that means when you are in this industry for some times, right, you will have to change your mindset that when good news, you behave conservative. When it is bad news, you behave optimistically. So it takes time for you to train your mind to be that contrarian state. Yeah.
Okay. So for our next question, does moving average of 220 days applicable for short-term, medium, and long-term analysis? How to
I would. Yeah. How? What's your next one?
How to determine the number of days if different?
Okay, so 20 days usually is for short term, 200 days for long term. Okay, so but I put these two together because I want to, at one glance, I look at the chart. I want to see what's short term and the long term kind of support and resistance. So that's why I put these two together. But if you want to analyze the short term, you focus on the 20 day or the 10 days will do. And if you want to focus on the long term, then you can look at the 200 days. But actually, I don't mind, I just put on it. And then because even if you are a trader or short term, not really like weeks, even if you are a short term trader, like weeks or days or weeks kind of a trading habits, right? This 20 day and 200 day does play a part because when the price move up, then you will see that whether this 200 day moving average will act as a resistance, will prevent it from moving up further. Okay, and usually this 200 day moving average is a strong resistance, even though if you are a trader. Okay, you can see that as a resistance line as well.
Okay.
Yeah.
So the next question is, can we apply Fibonacci together with trendline?
What Fibonacci is it?
Yes.
Yes, definitely. Okay, because Fibonacci is talking about retracement. So therefore, this retracement is also a very important part in the chart pattern analysis, because you want to see how far it go and then how far it retrace. Okay, and then when it retrace, there are certain levels. Okay, so that will be on another topic, because Fibonacci is actually on an intermediate to advanced level.
Oh, okay.
Yeah.
Okay, so for the next question, does low volume render a chart pattern or trend lines invalid? As we zoom from this minute.
Not necessarily. Sometimes even low volume, but then you have a big bar, right? Then psychologically, the next day, then people will go in already. So from the experience, sometimes low volume doesn't mean that it's invalidate. No, sometimes the low volume, it could be a turning point. Okay, after the low volume, then suddenly the next day the volume come in. So I wouldn't say that low volume is invalidate now. Yeah.
Okay. So is Gartley pattern a good thing to look at?
How to spell Gart? What do you mean by Gart? How to spell Gartley?
Gartley.
Gart.
Yeah, Ley.
I have no idea what is this. Maybe I need to Google this Gartley. Is this a technical term?
I'm not sure. It's a question by one of our attendees.
Okay, maybe I can check it later.
Okay.
I think it's a technical.
Yeah, so we can answer that later. So for our last question for tonight, RSI stochastic indicator is more suitable for long-term and blue chip stocks?
Yeah, I usually use that to buy long-term blue chip stock. I will set the criteria as a RSI 2080, and then below the 20, then time for me to buy. Yeah, and then you look at the weekly instead of the daily. Then you will see that it's quite predictable in a way that whenever there's a it touches below the 20, then when you buy, most likely that one is the bottom of the market.
Oh, okay.
Yeah.
Okay, so Pauline, that's all the questions we have for today.
Okay. Yeah.
So I will just take back the presenter. Okay, and just show my screen. So,
Thank you.
Okay, thank you so much, Pauline, for the very insightful session today. And thank you
Thank you
everyone
for having me.
and thank you everyone for being lovely attendees today. So I will just move along to the next slide. So for our next webinar, we will be having a Chinese webinar on the 9th of July. So this is our Bursa Chinese webinar every second Tuesdays of the month. So the time is 8:30 p.m. to 10 p.m. And I will just drop the registration link here at the chat box for everyone. So if you want to register, you can just register now. Okay. So yeah, that is the link for the next webinar. And so thank you again, Pauline. Thank you so much. So this is Pauline, the director of Sigma Wealth Sendian Berhad, for tonight's insightful webinar. And her website is alphaacademy.biz.
Okay.
Okay.
Bye-bye.
Bye-bye. Thank you, everyone. Thank you, Pauline.
Thank you. Thank you.
Bye-bye.